Meta stock has been on an absolute tear for the last couple of years, climbing higher and higher while rewarding investors who believed in the company's shift toward AI, efficiency, and stronger financial discipline. But now, suddenly, we're seeing a dip. Not a crash, not a collapse, but a meaningful pullback that has investors asking one big question: is this the dip to buy, or is something bigger brewing underneath? Today on Stock Predictor, we're breaking down why this meta dip looks tempting, but might not be the right moment to jump in just yet. Most dips look like opportunities at first glance, especially when you're dealing with a giant like Meta, a company with strong profits, huge cash flow, and dominant platforms like Facebook, Instagram, and WhatsApp. But not every dip is a buy the dip moment. Sometimes a dip is a warning, a pause, or a sign that the market is adjusting to new information that investors can't ignore. In Meta's case, several factors are signaling that while the long-term story still looks strong, short-term risks may grow before they shrink. The first thing we need to talk about is valuation. Meta is no longer the same discounted stock it was during the 2022 crash when it fell below $100. Back then, the market was pricing in the collapse of ad revenue and rising expenses from the metaverse. Today, things are very different. Meta is profitable, efficient, and stronger than ever. But the stock's price now reflects that strength, and that means every dip isn't automatically a deal. Before the recent pullback, Meta was trading at a valuation that assumed extremely optimistic future growth, especially in AI and digital advertising. When expectations rise too high, even small disappointments can lead to sharper drops. This dip isn't happening in a vacuum, it's happening after a huge run-up, and that changes the risk-reward balance. Another concern is Meta's heavy spending cycle. The company is aggressively investing in AI infrastructure, data centers, custom chips, and long-term metaverse development. While these investments may pay off later, they are expensive now. And anytime a company increases spending during a time of uncertain economic conditions, investors become cautious. Meta's capex is expected to keep rising, and when a company spends more, profits naturally cool off in the short term. Markets hate uncertainty, and rising costs without immediate revenue to offset them can create exactly the kind of volatility we're seeing right now. On top of spending, we're seeing potential pressure on advertising trends. Although Meta remains the king of digital ads, the overall ad market is sensitive to economic slowdowns. If interest rates stay higher for longer, or if companies pull back on marketing budgets, Meta will feel it. Even small adjustments in ad demand can hit giant platforms like Meta hard because advertising is still its core business model. Right now, analysts are watching for signs of slower ad spend, and some signals are already flashing yellow rather than green. When investors sense the possibility of a slowdown, they often sell first and wait for clearer signals later. There's also the regulatory storm that never fully goes away. Meta is always in the crosshairs, from the FTC, from Congress, from European regulators, and even from privacy groups. And this isn't just noise. Every regulation that threatens data collection, targeted ads, or platform operations can directly impact revenue. The EU's Digital Markets Act, for example, continues to force platform changes that can weaken Meta's advantage. In the US, antitrust debates are growing louder again. Even if these aren't immediate threats, they keep downward pressure on the stock and can add sudden volatility when new announcements surface. Buying during regulatory uncertainty can be like buying near a hurricane. You don't know how strong the next wave will be. Meta also faces rising competition, especially in the areas where it needs to dominate to justify its stock valuation. TikTok continues to hold incredible influence with younger users. YouTube remains a major competitor in long-form, short-form, and live streaming. Snapchat still owns a big chunk of daily engagement for teens. And in AI, Meta is spending huge amounts just to keep up with companies like Google, OpenAI, and Microsoft. The market is crowded, and user attention is harder to hold. While Meta does an impressive job with Instagram Reels and WhatsApp expansion, the competition adds risk, and that risk matters when a stock is priced for perfection. Another reason to be cautious is Meta's dependence on continued user growth and engagement. Even though Meta has billions of users, the company still needs growth to satisfy investor expectations. But how much bigger can a platform realistically get when it already serves nearly half the world? Growth becomes harder when you're already massive. Any slowdown in user additions or engagement can hit the stock quickly. Investors tend to punish large tech companies when growth decelerates, even if profits remain strong. Then there's the macro picture. Inflation is cooling but not gone. The Federal Reserve may not cut rates as quickly as investors hoped. The global economy is still battling uncertainty, and consumer spending remains uneven. Tech stocks move heavily based on macro sentiment, and Meta is no exception. When markets become risk-off, high-valuation tech stocks are usually the first to pull back. A dip during macro uncertainty is very different from a dip during a strong economic environment. When the ground is shaking, you don't want to stand too close to the cracks. Let's also talk about earnings expectations. Meta's revenue growth has been strong, but expectations are even stronger. Analysts are forecasting aggressive revenue increases driven by AI-powered ad improvements, Reels monetization, WhatsApp business messaging, and future VR/AR products. But here's the issue. When expectations are extremely high, it becomes easier for the company to miss or slightly disappoint the market. And when that happens, stocks fall, even if the business is still fundamentally strong. A dip before earnings is often a sign that investors are preparing for results that may not meet the hype. Investors should also consider sentiment. Right now, a lot of the money flowing into Meta has been momentum-driven. When stocks rise quickly, traders jump in hoping to ride the wave higher. But those same traders exit quickly when momentum slows. This magnifies dips and can turn normal pullbacks into deeper declines. When sentiment cools, the stock can fall further than expected before stabilizing. That means this dip could continue until long-term investors step in again, and we may not be at that point yet. Another factor is buybacks. Meta has been aggressively buying back shares, which helps support the stock price. But buybacks work best when a stock is undervalued, not when it's expensive. If Meta slows buybacks or shifts spending toward AI infrastructure instead, the stock may lose one of its strongest support systems. And with the current spending cycle, it wouldn't be surprising if buyback intensity cools down a bit in the future. Now, does all of this mean Meta is a bad stock? Absolutely not. Long-term, Meta still has one of the strongest business models in the world. The company has unmatched reach, massive cash reserves, and powerful products that drive global communication. Meta is becoming an AI giant, not just a social media company. WhatsApp monetization is still in early stages and could become massive. Reels is stronger than ever in taking market share from TikTok. And Meta's long-term vision for digital infrastructure, including the metaverse, may ultimately pay off. But here's the truth. Strong companies can still have bad entry points. Buying high during uncertainty often leads to regret later. And the risk with Meta right now is not that the company is weak, it's that the stock price may still be ahead of reality. That doesn't mean Meta will crash. It simply means investors should be patient rather than impulsive. A better entry point may still be ahead. We need to remember something important. Great investors don't just buy dips. They buy smart dips. Not every pullback is the same. Sometimes a dip is just the beginning of a bigger correction. Sometimes the market is adjusting to new risks that aren't fully priced in yet. And sometimes the best move is to wait, watch, and prepare instead of rushing in. Meta may still drop lower if the market remains volatile, if the next earnings report disappoints, or if spending continues to rise faster than revenue. A deeper dip would give investors a much better margin of safety. And margin of safety is everything in investing. You want room for error, because no company, no matter how strong, grows in a straight line. That's why this doesn't look like the dip to buy, yet. There may be a better opportunity coming, and patient investors often win the biggest. Meta's long-term story remains powerful, but the short-term landscape is cloudy, and when the weather is cloudy, waiting for the storm to pass is often the smarter move. So what's the strategy right now? Simple. Stay alert, not aggressive. Track earnings. Watch spending trends. Monitor ad growth. Keep an eye on macro signals. And most importantly, wait for a dip that reflects actual value, not just temporary volatility. You don't have to buy every dip. You just have to buy the right ones. And this one, for now, doesn't look like it. If you enjoyed this breakdown and want more intelligent, data-driven stock analysis, make sure you subscribe to Stock Predictor for smarter investing insights. Thanks for watching, and I'll see you in the next video.